as the U.S. Federal Reserve on Wednesday raised its benchmark interest rate by a half percentage point. A Nairobi-based expert warns that we're going to have a vicious cycle, where there's less money in the U.S. and definitely less money going to the developing world. The Fed's latest move marks the sharpest rate hike since 2000, as it takes more aggressive steps to rein in the highest inflation in 4 decades.
The high interest rates are supposed to stabilize consumer price index. And if that happens, then definitely there's going to be now less money in the economy. So it is going to have the opposite effect. And there'll be less spending, and the economy will go on a slow, and definitely it will have the ripple effect across the social and economic sector. And so we're going to have a vicious cycle where there's less money in the US and definitely less money going to developing world. So the developing world will be forced again to seek for alternative sources of credit, which will be more expensive by virtue of that the bilateral lenders who are maybe more easy will not have money to give. Now, already we can see the effects of a high dollar, in developing world. So the prices in countries like Kenya and other developing countries, there's high price hikes as the dollar then becomes more expensive to purchase from the market. So again, it is going to be a vicious circle where the big corporates are able to gain more income from producing more goods, but then these goods are going to be so expensive to the poor and to the developing world in general.
The Fed usually lifts interest rates by a quarter percentage point, and the newly announced half percentage point rate hike, along with imminent move to shrink its $9 trillion balance sheet, would mark a shift to a more aggressive tightening mode.